all these numbers and the CPI and the PPI and all these rates and interest rates and mortgage rates and long-term and short-term got you confused? Well, this month on the real estate market update for the Denver and the suburbs, we're going to dive into the economic effect of, all of those things that are going on in the macro economy and understand exactly what it means to us and the housing market and what it looks like boots on the ground here in Denver. So stay tuned. What's up, guys? Jeremy Kane, eXp Realty, living in the Denver suburbs. This is your November 2023 market update, and I strive to bring you information as it comes to me. I partner with some of the very best lenders and title reps in the country, really, to bring you the very best information, statistics, and breakdown. We give you boots on the ground from my perspective as an agent. Some great statistics. Nicole Ruth and Megan Aller do a great job of helping keep us informed, and I'm bringing that to you. So if you like what you hear, stay tuned. If maybe you're not in the market right now, but you are, bookmark it, give me a subscribe, and I will always have up-to-date market information for you to make the best informed decision when it comes to your real estate investment. My goal is to help everyone I possibly can build wealth through real estate. So let's get into November 2023. It's turkey time. We got some good news from the Fed for once. The Fed decided to hold rates in late October, and so that's really helped. U.S. economy in quarter three had significant 4.9% GDP, doubling the previous quarter's growth. So that's all positive information for the economy. And obviously from that original two negative quarters of GDP, that used to be what a recession was defined as, and we're still not technically in the recession that we weren't in when that happened last time. And so we're continuing to move forward. The labor market is really what's kind of throwing the Fed for a loop, but it did come in higher, which is what they want in order to lower that Fed rate eventually, hopefully, or at least stop the growth. So that did happen. Inflation is still the thing. Core inflation at 3.7, above the Federal Reserve target of 2%. So that's really what we're trying to get to, and keep that inflation under control. And that's when we might see the Fed start to consider lowering that rate. And I want to be specific. The Fed rate is kind of a general consensus of the economy. It is not directly correlated to the 30-year fixed mortgage rate, which is obviously what we are most concerned about in the real estate industry. But the entire economy and, kind of ebbs and flows based on that. The stock market reacts. They pull from stocks to bonds. In certain markets, when people go into the bonds, that's when the mortgage rates typically go down because we have a strong mortgage rate environment. So that's definitely part of that. Now, all of this kind of comes into play, but how are we feeling at home, right? Consumer spending's high, the credit card debt's high, the savings amounts are low, and so that's really what it's at. Cash on hand, what people are doing, obviously the credit card debt's high, but so is the credit card interest rate based on, these short-term rates and things like that. So we have to really understand what is putting this on. And here comes the holidays. Here comes, a time when we spend a lot of money anyways, and we need to kind of pull back on spending for the Fed to feel like they're doing something right. So at the end of the day, mortgage rates at the close of October were, record high. Since that, and since some of these statistics were put out, we have seen two very good reports come out that have helped lower the rates. We've seen almost a point decrease in the rates from the top. Still not anything desirable for most people, considering a lot of America is locked in below 4 and 5%. But things are moving in the right direction. A lot of the lenders I'm talking to are thinking that we'll stay steady. We'll see a little bit up, a little bit of down, a little bit up, a little bit of down, but we will see as we move forward there. Okay, let's get into the real estate stats. 2.63% in listings year over year. This is obviously a little bit of good news as the inventory has been so limited. We're still very low in inventory, but we are, hovering between the 2 and 3 months of inventory, which is nice. And very typical for this time of year. Buyers tend to start buying turkeys instead of buying houses, and people start to kind of pull their house or expire it, withdraw it. So the increase in listings is actually a little bit abnormal for the month of October. But if we see that increase in November, it'll definitely be, kind of odd. So that's part of what's going on with the inventory. Not a major thing, not going to completely shift the market or anything, but something to consider. Mortgage rates and applications are down 9% in October. They are the lowest currently as they have been since 1995. So the buyer demand is definitely out. I will tell you, when we did see that rate drop just a half point, before it dropped another half point at the time of this recording, we saw a 2.5% increase in mortgage rates or mortgage applications just for that week. So buyers are watching that. Obviously, with the holidays and things, that'll be a little bit tempered. Whereas if we would have seen that drop in the spring season, we probably would have seen even more than a 2.5% increase. The median home price trend, it's 2% lower than it was last year. Now, this is the median. We won't talk about the average, but it is on trend for 2019. A lot of these statistics that we look at, we compare to 2013 to 2019 because that was kind of our last real normal market. The COVID years kind of get thrown out with the wash. So the fact that we're kind of on par with 2019 is, something pretty positive. It just feels different in our market because it's been so wild as agents, as lenders, as title people. We've been so busy in all the things and transacting and doing all of that, working on our relationships. And now as the market tightens, transactions go down. Lenders are probably the most affected because cash offers are up, refis are gone. Something to consider there as well. Give your lender a hug. So let's break it down from a seller's perspective. Sellers are continuing to be pretty bullish. Listings are 19% down, so they may be holding out until, that interest rate drops and we get the demand so that they can get that top dollar. Now, one thing that sellers may not be considering is what they're going to purchase on the next side, because now may be a time to get a deal on their next purchase, especially if they're moving up, versus holding on and waiting to get top dollar for this one, because if they're moving up in the same market, their top dollar for this one's going to be different. So that's kind of what the sellers are doing, kind of still pretty gritty and doing the thing. I will tell you that I think 68% of all deals closed in October had a seller concession attached to it. So that is something that we're doing. We're using the seller kind of net to mess with the monthly payment and essentially are financing those concessions into the transaction as the buyer. However, those buy downs and the 2-1 buy downs and the permanent buy downs are absolutely huge. And so as we shift kind of the buyer's mindset, if we can hit that monthly payment that's comfortable, that's where buyers are really kind of dialing it in. So these buy down opportunities are absolutely something to consider, and getting in, certainly inventory, although down overall 19%, the inventory is limited. So the house that you're buying, buyers are being a little more picky because they have to be. And so as those buyers kind of look at that, through this holiday season, the homes that are on the market are wanting to sell. So they do have a little bit of opportunity, which I talked about in my video last week, of, getting that buy down, getting in a, at least as comfortable as possible mortgage payment and going forward. And I don't say that lightly. I want you to be comfortable. That's the most important part of my job, is that the buyers that I put into homes are comfortable in their mortgage payment. But as we kind of move through this, and as December comes and the new tax bills come out and the new insurance bills come out, we're going to be pushed to higher costs for living, right? So that means your rent's going up too. So you're not winning because you're renting, because that's just going to be passed right on to you in 99% of the situations out there. So understand that that's coming as well. So buyers have a little bit of time while the holidays, while everyone's distracted, to get in and maybe get some concessions at least, as opposed to maybe getting a quarter or half point lower interest rate, come whenever they drop, for good, or whatever we say. They're never going to drop for good. But once they get into, a safe range, 6%, I've heard people say 5%. I don't think they're going to 4%. So if you're waiting for that, you might want to, reconsider. But if they get into that range that's desirable, we'll see a flood to the market, prices go up, and all of a sudden you're still paying the same amount. So that's definitely something to consider there. We have heard a lot about institutional investors. Obviously, with RFK running for president, or trying to run for president, he talked about maybe by 2030, 60% of all single family homes in the United States owned by institutional investors. That means there'll all be rentals. That means more than half the country, will be rentals. And so that's not good. That's not a positive feat. And part of that's the affordability. And so as buyers and first-time home buyers and people that are, trying to utilize some of these government loans and some of the lower down payment loans, this literally could be one of your last opportunities to buy a home that, a single income could support, right? I mean, even the average home price right now in Denver would need, $130,000, of yearly income to kind of make those numbers work. So that's something we really have to keep an eye on. But as these institutional investors push forward and they're still in the market, they're still doing it, we have to understand that if their goal is to get to 60% ownership by 2030, that's 7 years away, 6 years away almost here, right? So we have to understand that that's coming, and we have to, the Blackrocks, the Vanguards, the State Streets, they could own 60% of single family homes in the United States by 2030. I don't think it'll be quite that much, but regardless, the push is coming. So that's not going to help anybody with a low down payment compete in any market or get into a home. And home ownership is so important and such a key piece of building wealth that this is something we need to talk about now, so that you're not sitting there in 2030 being like, okay, now I'm renting, now I'm paying these big corporations rent, and they don't give two craps about me, so they're raising the rent whenever they want. I have zero control of my wealth and my future. And so that's what I want to avoid. So I want you to hear that point if you hear one thing out of this market update. So ultimately, we have to endure, right? I'm not changing my goal of helping others build wealth, helping people build wealth, not corporations, through real estate. And so we have to understand that that's exactly what we need to do. There are opportunities. Certainly there are challenges, but home ownership, the value endures. There is no better way to build wealth than through real estate. And even if your goal is not to be wealthy, so to speak, whatever your definition is, getting into a home is ultra important. I know that in the Denver market, those first-time home buyers, those people that don't own homes, their opportunity is slipping. And I understand the price tag is heavy right now, but I don't think that price tag is going down anytime soon. I don't care what happens. It's an inverse effect. As much as we watch the rates now, as those rates drop, people flood the market because the information is so readily available and broadcast all over socials. And that's a testament to the people out there, real estate agents, mortgage people, doing it. And so I just want you to hear that we have to balance affordability with necessity, but we also have to understand what's coming down the pike. And I'm not sure that that's positive for those first-time home buyers, those low down payment buyers out there. So I hope you hear that message. I also want you to hear that people are still building wealth and making money in real estate. It's not like the crazy gains that we've seen, but it's still moving along. So if you want to have a conversation, a serious conversation, and look at your situation and make a plan, right? It might not be today, right? It might not be possible today. It might not be within your plan to do it today. But if a move or a move up or a downsize or anything is within your future, you may want to forget about the, crazy low interest rate. Understand that if you have a crazy low interest rate, but you have a car payment with a 10% interest rate and a credit card payment with a 25% interest rate, and your debt's stacking over there, your blended rate might be something that you might want to get rid of, and maybe it makes sense to, you know, refinance or make a move and kind of pay off some of that debt and put yourself in a better cash situation. So all of that stuff, I'm glad to talk to you about it. Understand that homes are still moving. There's still agents having really good success in these markets. It's not like it just turned off. It slows down seasonally anyways. It's a little quieter now because the rates and all the media around that. However, like I said, at time of this recording, the rates did just drop and we did see a little bit of influx to the market. So I hope this helps you. I hope you understand that your situation is absolutely the only thing that really matters, and all of this stuff that I just talked about for the last 10 minutes doesn't really matter. It matters what your situation is, and that's exactly what I dial in. Book a consult below. I'd be happy to chat with you on Zoom, grab coffee, lunch, whatever that takes. My goal is to get you into home ownership, and if you're watching this and you're freaked out and you have no idea what I said, just book a call and we'll chat. Like, comment, subscribe. We'll catch you next time.